Does today feel like 1999 to you? Because it does to certain famous investors. Michael Burry said earlier that the last months of the 1999 to 2000 bubble feel a lot like today's market. Paul Tudor Jones from CNBC's show Squawk Box says that it does feel like 1999, but we could still have another year or two. So I guess it feels like 1997 to him.
Yeah.
But investors are split whether or not we're in a bubble or near market demise, for lack of a better term. And with that cheery note, my name's Josh Nahosa, and I am the host of this podcast put on by Swan DFW. And all of our contact information will be down below. And the man on the other side of the screen is named Hector Nahosa, and he's the man that started Swan DFW all those years ago. He is very experienced. He's a CFP, which he likes to tell everybody means he's good looking and smart, and I will give him one of the two. So, Hector, how are we doing today?
We're doing good. We're good. Just recovering from our trip to New York. We heard a lot about the stock market, but yeah, doing good. Thank you
Yep.
for asking.
So, today's general topic, I guess, is today's market like 1999? There's some similarities, but there's certainly some differences as well that we're going to break down. So, how would you like to get people started?
Well, it's like the old adage, some of my friends think it's like 1999 and some of my friends don't. And I agree with my friends. The reality is you can look at it and go and try to figure out try to find what it is what you already think if you have a conceived idea. But but really, this once a couple of the similarities are that that's a new technology. In 1999, 2000, it was the internet. We really didn't know what the internet was or what it would do. We were being told it was going to be amazing and it was going to change our lives. But for many of us, we just didn't really understand how that was going to happen. And that's what's happening with AI today is that people are saying, oh, this is going to change our lives dramatically. And it's a whole new industry. And so that's a really similarity. It's kind of like the same song, different verse. It's brand new. It's got potential for the future, but many of us don't really right now understand how AI is going to change our lives going forward. So that's a really good similarity.
Yeah, so I guess let's get into three reasons why today kind of looks and feels like 1999. And then after that, we're going to talk about three pretty critical differences. So this is
Right.
not like a doomsday podcast, but it's also not like a cheerleading podcast, I guess. We'll give you both
Yeah.
sides of the coin. The first difference, or excuse me, the first reason that it's similar is that it's brand new technology. If you remember back in 1999, it was the dot com boom
Yep.
first before it was the dot com bust. And that kind of feels like AI. It's a brand new technology. No one super knows how to monetize it yet, but it's exciting. And there are companies certainly that are monetizing it. But it feels similar because it's brand new and no
Yep.
one really knows yet.
That's right. That's right. Yeah, and yeah, and we're being told like the same thing. It's going to be amazing and it's going to be incredible. And for some of us who can't are not visionaries, it's just really hard to see where it's going. Although more and more people are using AI on a very small scale on the retail level. But yeah, you're exactly right. Though that's the big similarity.
Yeah. Another similarity is some pretty extreme valuations, we'll say. Why don't
Right.
you talk about that?
Yeah, we had I think the best way to do that is compare the two leading companies of then and now. One of them back then was a company called Cisco, one of the top companies, and it was being priced something around 27 times its sales. Everything back then was based on sales or future sales projections. And if you've been in the business long enough, you can project anything you want to. And right now, Nvidia is not being priced on sales; it's being priced on earnings, but it's got a pretty high valuation as well. So that's a similar thing, but a little bit different. We'll talk about that, just the way that they're looking at it. But yes, valuations are higher today because you have more buyers and sellers, and that forces prices up. And so that's very similar.
So while we're here, why don't you dive in a little bit more on how those two uh, ways to price a stock are different, right? You said one is based on earnings today and one is based on future projected earnings.
Or even sales. Let's say that I'm selling something at $100. Let's say that I'm selling my coffee cup at $100 a coffee cup, and the earnings ratio or the ratio is 27 times. Well, if it's 27 times sales, that's 27 times $100. That's a pretty big number. If it's on earnings, if I'm selling it and my profit is only $30 for each cup, then the ratio of 27 is to the 30. So although the number looks the same, the constant that you're using, the variable that you're using is way different. Earnings is what you're actually making, and projected sales is, I can say I'm going to sell 1 million of those, and I can give you some rationale now. But the reality is, when you price it on earnings, it's I've sold it and I've made the money, and here it is. It's much more solid today than it was back then.
Gotcha. Similarity number three here. It just says speculative fever beyond the mega caps. Why don't you dissect that sentence for the people at home?
Well, what so way back in the movie Wall Street, which also came out of the 90s, I think. He says the main character talks about how the market is driven by two things, fear and greed. And when things keep going up, our greed takes over. And so all of a sudden, money is pouring in, not really understanding what companies are doing, but nobody wants to miss not be invested in the right companies. And so you have all of, especially retail money coming in because they've seen all this money made and they just think it's going to keep going forever. And that's the fever. That's the everybody's excited and everybody wants in. And again, when you have more buyers and you have sellers, markets go up, and that's kind of where we are. And that's what people are saying. There's too many people coming in chasing profits. And so that's a really big similarity. How'd
So
I do? Was that okay?
yeah, I think so. So
Okay.
the let's talk about some of the differences. So we kind of talked about one um, is how they're valued, but a part two to that um, is these companies are actually making money.
That's the big thing is, companies are designed to make money. They're designed to create a product, to have a vision, but you got to sell something. And then when you sell it, it needs to be profitable. And I remember watching CNBC in the 90s, and they were talking about this new paradigm that a company really didn't need to make any money. What it needed to do is be a dominant in their market and have lots of sales. And that's just totally contradictory to what basic business teaches is you got to be profitable. And so one of the big things today is that these AI companies are very profitable. As a matter of fact, a company like Nvidia and I was listening to the CEO of a company called Lithium. I think that's the name of the company, ticker LITE, was saying we have sold everything we can make in 2027. So if you send us an order, I mean, in 2026, send us an order. we'll take the order and we'll charge you for it, but we can't deliver it until 2027 sometimes. That's a good thing for a company to know that everything your people are making is already sold.
Yeah.
Huge difference than what it was in 1999, 2000.
Yeah, I guess right now, while we're just name dropping companies, would be a good time to tell everybody at home this is not investment advice or actionable advice. You should talk to an investment advisor because everybody's situation is different.
Yeah.
And
Yeah.
you should not just go and blindly invest in any of the companies, excuse me, that we talk about
Right.
on this podcast.
Exactly. This is not anything actionable. This is just for entertainment and education. If you want to talk to us, we can make ourselves available because that's the kind of guys we are.
Yeah, and all our stuff will be down below. Difference number two, uh, and this kind of ties in with difference number one, but the AI capex is real. It's like it's a big thing. Like money is actually flowing into and out of these companies.
Yeah, CapEx simply means capital expenditures, that you're spending stuff on building plants and creating new technologies and stuff. So in 1999, 2000, almost all of that was being funded through borrowing. They were bringing people in and borrowing a lot of money and then building the things. The difference today is that all of the new um, uh, manufacturing plants and technologies is also a lot of money is being spent on CapEx, but it's being funded through the profits that are coming through the front door. And so that's a huge difference is we're funding this thing to cash flow and not taking on debt to continue to grow our company. So that's a fundamentally another big fundamental difference between now and then.
Yeah. Uh,
But again, it'll feel the same because there's a lot of money going into CapEx. It's just where the money is coming from. That's why we say trust in your feeling sometimes is not a good thing.
for sure. Our last difference is the macro backdrop is almost exactly the opposite of what it was in 1999. Why don't you talk about that for a moment?
Yeah, the Fed, and we're talking about primarily the Fed. The Fed was aggressively raising rates to try to slow things down in 1999. And when you're investing with the Fed raising rates, that's called fighting the Fed. And so when you had all of this money being borrowed to fund the new plants and technologies and R&D and stuff like that, um, and interest rates are going up, that's a very poor combination of things going on. Today, the Fed is fairly quiet. The administration wants it to cut rates. It's hard for them to cut rates right now, but they're certainly not raising rates, at least as of the middle of May 2026. And so again, the macro, the big picture behind the thing is way more in line with a market that will continue to go up for a little while.
Yeah, for sure, for sure. Some caveats, of course, we should throw in that I'm sure people will be keen to point out. Cisco at the time was profitable or was at least churning profits, but a lot of the .com companies that went under, we don't remember or won't remember, or if we remember it, you certainly won't for listening purposes. But that stock fell by 80%,
Yeah.
which is
Well,
tough.
and it is tough and people were changing companies were changing their names to add at the end of it .com. So it was Sharpie Highlighters.com was the new name of the company because anything that had a .com at the end of their name, people were thinking this is going to be a big deal. And so, yeah, when you had all that money flowing into companies that were not profitable, and then the market started to slide, there was no bounce, and we took a fairly big hit, like 30-40% in the S&P 500. Not to say we're not going to have a slide because that's what markets do. They go up and then they come back down. But I suspect because the companies today are much more profitable and have more gravitas and they're real. We can always anticipate in a normal market condition a pullback of 10, 15, or even 20%. But I don't think it's going to go to 40 or 80 in the companies that we're talking about and investing in.
Yeah. So I guess to tie a whole bow on this, I'm going to ask you a question as though I'm a listener.
Okay.
Um, what does this mean for my plan? Do I need to make any large things besides calling you? Or,
Well, there's a lot of as a financial planner, there's a lot of things that I encourage people to do. One is to rebalance portfolios because sometimes with the runs that we've had, they could be top heavy, they could be way more aggressive than you needed to be. So we need to watch that and make sure you're in line there. Secondly, taking some profits. If you've been in the market, for some of our clients right now are beginning to take money out of the market to pay for things for expenditures they're going to have throughout the rest of the year. Nobody's ever gone broke taking profits. So if you know you have an expenditure that's coming up in the next little bit, buying a house, buying a car, this is not a bad time to pull some money off the table and go and buy it because that's what this whole thing is about, right? And then the big thing is be prepared for a pullback and don't panic. That would be the thing that I would tell you is that in a well diversified portfolio, even in a very well diversified portfolio, we're going to have some pullbacks, and the big thing is not to panic. We're expecting it. We want to run this thing up as far as we can, take some profits when it seems to make some sense, maybe rebalance the portfolio. But if it does pull back, not to panic, because just like the internet changed our lives in 2000, AI is going to change our lives in ways we can't even understand sitting here today.
yeah. Um, so, I guess if you have any questions about anything you've just heard or want to talk to two part-time podcasters but full-time financial professionals, we have a couple of different ways that you can do that. The first of which is an email address, and that is info@swan.dfw.net. The second is a phone number, and that is linked below in the description. I believe it's 888-792-6339. Um, yeah, so give us a call. It's free to call, free to email. We'd be happy to talk to you about your financial plan and retirement.
Yeah. And give us a like, send this podcast to somebody that you think maybe would enjoy it. And yeah, let's have a conversation and see if there's something we might be able to do for you.
Yep. So thank you guys for watching. We'll catch you on the next one.